both groups can be rigid and flexible in their own ways. And that goes back to the point why it's important to have relationships and the ability to raise both if you want to put yourself in the best position to do deals. And that's because, just to use dramatic examples, if you have a deal that has no cash flow, like a heavy value add turnaround or a development play, that's going to be a lot harder to raise on the retail side, because retail investors are more primed and looking for cash flow. Whereas institutional investors, they've got their IRR parameters, and many of them don't need any cash flow. They're just solving for total return. So they're fine investing in a deal, waiting 2 years and seeing returns later. So it just depends on the deal. Different styles of equity can be more flexible, more rigid. Certainly, if about the speed that you mentioned on the retail side, you're as fast as you are. If you have the relationships and the skill to raise equity quickly, then you can close quickly. But at the same time, there are institutional groups that's what they specialize in as well, right? They'll tell you, hey, we're not the cheapest partner, but if you need to close in a week, we can do that. We can make it happen. And maybe they even have the ability to close all cash and then refinance on the back end because they have a balance sheet. So it just depends on the types of deals that you're looking to do, and then to match it up with the right equity.